Hey everybody, my name is Brad and I'm doing a double hitter recording apparently. One thing I noticed when I recorded my last video is my little overlay above with my name is incredibly pixelated. I'll have to fix that, but bear with me. I'm trying new things, having some fun with kind of recording to get back in the swing of things and mess around with a couple things. But yeah, it looks really bad, so sorry about that, but here we are. So I want to do another video basically on a thought process or how I approach the charts from a review standpoint, because there's going to be some days in your trading journey or just in general where you're not going to be able to hit the charts. You're going to be busy with work, you're going to be busy with kids, you're going to be busy with other things. Yesterday, for an example, my daughter had her first day of preschool, so I dropped her off and did some things with that, so I wasn't on the charts. But it's important to review the session or review each session to make sure you understand what's happened, keeps you in tune with the market. It makes sure that you understand how to apply the strategy on a daily basis. There's been a couple questions in the past of, what's the point of doing daily markups? What's the point of, jotting down what percentage you could have made in that particular day or session or week or whatever when you're doing these review processes? And it's a really good question because on the onset, maybe that instills FOMO in certain cases, but what I think, or my perspective on the daily review process and, kind of writing down the percentages that are available within the session, the day, the week, depending on when you do your review process. It's key to do that because you're training your subconscious to really understand and appreciate the level of opportunity that actually exists in the market. Because if we're not actually present with that, that's when we run into problems. That's where we get the fear of missing out. That's when we rush trades. That's when we just do things that maybe don't make sense because subconsciously, we don't think that there's as much opportunity. We think it's finite. Some people like to trade under the mindset that Forex isn't going to exist tomorrow, so I got to fill my bag as quickly as possible today. I don't think that's really going to happen. We need currency. We need money. That's what we're trading. We're just trading money from one country to another. Unless something fundamentally changes in the world where we don't have money anymore, we go back to bartering. I'll trade, 5 eggs for your chicken, or I don't know, bad example. But, if we were to do something like that, then yeah, maybe that would change. But then, knowing how smart we are as a civilization, we'd probably create a price chart or CFD for eggs to chickens and stuff like that. Why? Because inherently that's how you would shift value. But as far as the market going anywhere, I really don't think that's the case. But anyway, I'll quit kind of rambling on that stuff and get into actually what I want to talk about. So if we go to Euro USD, you can see it's the same markups from the last video, but we're going to be more focused on current price action, more specifically the last couple days. So as we can see on the daily chart, we're starting to see some sort of bullish price action. We've basically had a change of character. I'm still waiting for this high to go to really give me the indication that we are switching to a pro bullish trend, but that doesn't mean that I'm not going to look for buying opportunities or selling opportunities or things like that. So when I'm looking at this bit of price action, initially this demand zone sticks out to me. This supply zone sticks out to me. This demand zone is pretty clean. We take out liquidity. We break some structure, some minor structure. This is what creates our change of character. We can see prices tapped into this. This supply zone maybe is a little bit more difficult to understand or to see, but this would be more of a pivot supply range. So if we look at this on a lower time frame, what we're seeing more than likely is something like that, where we get that sharp move to the upside followed by the sharp move to the downside. I go over that in the beginning of the refined course in the supply and demand section. So if you're a little bit uncertain of that, maybe just check that out, and maybe I'll even go through it as we go. But now what we'll do is we'll go down to the 4-hour charts and we'll just look at a few different bits because I think it's important to understand a few things. Yeah, that's fine. So what we're looking at is the little bit of price action here. More specifically, what I'm going to focus on is pretty much the end of October till present day, which is November the 2nd. But more specifically, yesterday's price action, we're still very much in the session. But again, what I'm looking at is we have that daily zone. we've just reacted off of this 4-hour zone, the pivot range that I drawed out on basically the wicks of the daily candles. But what we can see, if we just look at this price action, we have a move to the downside, a sharp correction to the upside, and then followed by another move to the downside. And again, we can look at it from the previous video. I won't go into too much, but we have a break of structure to the downside, a lot of struggle. What is this high likely going to be? It's going to be targeted as liquidity, which is why we see this, and then we move to the downside. We get an actual more or less follow through. We see our change of character. We're starting to see bullish price action on the 4-hour until about this point. Now we've switched back to bearish, but again, if we go to the daily chart, our range that we're operating in for the most part is this. So when we break this low, we haven't switched bearish on a daily chart. Maybe on the 4-hour we have, but daily we're still very much shifting to somewhat of a bullish trend. So what I'm looking at, when we're looking at this bit of price action, we've tapped into this demand zone. We tapped into it on October 29th, which was the Friday. Today is Tuesday. So we have our zones mapped out. We've already seen price tap into this. I have these lines here, which is the indicator New York midnight, and basically all that showcasing for me is when 12 a.m. Eastern is, which is the shift of a new day for New York, Toronto, things like that. My time zone. There's a lot of relevance to New York versus say GMT time, but again, this is just kind of how I view things. So what we're seeing is, on Friday's price action, we tapped into this zone. And if we want to dissect the price action just a little bit, what we can see is we created a change of character, and I'll zoom in just so you can see that a little bit better. So what we can see is we create this short-term high. It's kind of encapsulated within this wick. It's an inside bar. If you have your inside bar indicator on, I don't have mine on, but you can see it turned white. It's an inside bar. It's a little bit of structure. It's more structure on the lower time frame, but this is why on a 15-minute chart we can use this as a change of character, because we create a low, we create a high. The low is higher than the previous low. Then we break that low, so we've in essence created a new low. This would be our lower low within kind of more fractal price action. This is where I think the biggest challenge with changes of character come, because a lot of cases a change of character can be more viewed as fractal price action versus kind of major structure, because I think we can all agree that if we're looking at this from a market structure perspective here on the 15-minute chart, a high or a low, the structural points, I think is the best thing I'm trying to say, is would be, we have our low here, but our high is probably going to be somewhere up here. Why? Because this would have been our last low. This is our lowest low, our highest high. All of this is just kind of price action in between, because we don't actually have any tangible structure. If we look up here, we have what could have been a change of character, but we don't break the low. Then we have something like this, where we can use this as the low. It doesn't break structure again, and maybe I'll just zoom in just a bit. Kind of going off what I wanted to talk about, but that's okay. Do something like this. We could even use this as our low if we wanted to break to the downside. In this case, when it comes to changes of character and we're not sure which low to use, I wouldn't necessarily, if I did use this low, I wouldn't look to trade this wick or even something like this. We can see it gets run. What I'd be waiting for is to see a little bit more confirmed price action, something that's a little bit more indicative of a change of character to the downside, price shifting, because we don't have to be the first in the markets. We can look at something like this, we break to the downside, or even something like this. If we're looking at, I can't draw straight, but we can just imagine that this is a straight line. I could use a trend line. I'm sure we're all yelling at me for that. What we can see is we break to the downside. This could be our more solidified change of character, because it's a little bit more structurally driven. It's not as wick driven. We have a little bit more tangibility with these lows, and then we can start looking at supply zones. And for the love of God, Brad, use something that people can see things better. What we can see is we have a supply zone. We tap into that. We have a little bit of liquidity, because again, if we go back to the previous video or the structural video, if you haven't seen that yet, I don't know what I'm going to call it, so sorry about that. But what we can see is we break the low. We don't break it really powerfully. We break it, we immediately retrace, we create this little doji, and then we run hard to the upside. So we ask ourselves, what is this high actually within this bit of structure? It's probably going to be liquidity. What happens? Liquidity. But why are we gauging that as liquidity? I think that's probably the key and important thing to ask ourselves. The only reason we would view this as liquidity and not a potential change of character to move back to the upside is because, one, changes of character should only happen in supply or demand zones on higher time frame. So if we're on the 15 minute, we're looking for 4-hour zones. We're looking for that 15-minute change of character in a 4-hour zone. So if we look here, we've reacted off of a supply zone and we're starting to just kind of build that story. You know, we talk about that a lot, build the story, what's the narrative, blah, 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 blah. This is essentially, in essence, what we mean. You know, we're reacting off of a supply zone. We're starting to look at ideas or indication that price wants to trade lower. You know, specifically if we're looking at changes of character, again, you know, we're probably looking at something like this. This is a little bit more confirmed to me. You know, we've broken some actual key lows. Again, you can probably use something like this. You know, you break to the upside. Even if you use this as your low, for instance, you know, price is just kind of hanging out around here. You know, we can start to see that chances are supply chain is starting to happen above. So we do have an indication that, you know, we're starting to see supply really actually taking control. But it's once we break to the downside here that we start to actually get, you know, solid indication that we're starting to break to the downside. You know, it's that warm fuzzy feeling that, okay, I feel like, you know, taking shorts now really makes sense. And what we can see is, where does this tap come into? And this is where session timing can come in. We haven't really talked about session timing too much, but if we just look to the bottom, what we can see is this is about 3 a.m., 3:30, 3:15 Eastern time, which is London Open. I believe that's 8 a.m. GMT. So that's a key time in the market when a lot of volume gets pumped into the markets. And, you know, what do we see here? We see just price just run. And then we see price retraces at about 6 a.m. in kind of gear for New York to open. And usually we have a move between 8 and 9 a.m. Eastern time. That's the New York Open. Doesn't always happen, or it's not always as clean, but what we can see is, you know, we break structure, and there's probably something on a lower time frame that we could enter here. That's what this wick would be. This would be our New York Open trade, but usually it follows suit with London if we have a large range to be trading in, you know, because if we just look at what this represents, you know, it's a big liquidity void. Chances are price is going to fill that before we, you know, continue going lower. So now that I've gotten all that out of the way, that was totally a tangent that I was not anticipating in this video, but that's fine. Sometimes little happy accidents happen and maybe someone learns something, and that's my biggest thing. So anyway, so what we'll do is just continue dissecting this price action. This is Friday price action. You know, this is towards the end of the day. You know, we have 5 p.m. Eastern. This is when the markets close. Then this is Sunday price action. Sunday price action would be basically just this little bit here. They just put it as Friday price action because, let's face it, there's not much that happens on Sunday, and it's only, you know, 7 hours of price action, you know, from 5 p.m. till midnight, and then we start to actually transition to Monday. So anyway, before I just keep waffling on, let's actually talk about cool things. So what we can see, if we're just looking at this, is, you know, we're seeing a change of character. So we'd be looking for buys, you know, because we're in a higher time frame demand zone. That's the biggest thing. That's the key thing initially, is this is a daily demand zone and we're waiting for a change of character. We can refine it down to the 4 hour, but specifically, you know, if we're in a daily or 4 hour zone, we want to see a 15-minute change of character. If we can refine that daily / 4 hour zone to a 15-minute, then a 1 minute change of character we can look for. But if we're just being a little bit more conservative, maybe we only trade the 15-minute. This is a great approach. So, you know, if I just cut price back real quick, let's just take it a little bit further. I'm always never great with bar replay, but I'll try my best here. So what we can see is initially, you know, we have a supply zone. Why? Because price broke structure to the downside, and we broke it with decent momentum. You know, it's a pretty decent continuation to the downside. Yeah, it's not a massive amount of pips. You know, it's only 11 pips, so we're mindful of that. But we also know that we also have a larger range to consider. If we are going to still continue trading bearish, we can move to the upside. But again, we're tapping into a higher time frame demand zone. We're starting to see potentially a change of character. Obviously, from here, we don't actually have a change of character just yet. So reacting off of the supply, we have this reaction here. We start to see price trade away from that. And then we see price break the reaction, which would be this wick right here. We've now, in essence, violated the supply zone, if you will. And what we can look at two different points of structure to ask ourselves, where can we trade long from? We can trade long from the extreme, which is probably a decent area to look from. Oops, if I pick the right color. There we go. So we'll use this nice dark one. And then we can also look at, a flip zone. What caused this supply zone to essentially fail? Where's the last point? We could probably look at something like this, which is a doji. More specifically, we could probably look at this bottom wick. We'll just keep the whole doji. We'll play price on and just see what happens. What we can see is, we'll just keep moving this up a bit. We tap in, so if we were looking for trades here, whether it's the 15-minute or if we looked for a 1-minute trade, we can see that we do react off of the supply and demand zone flip area. If we're looking at kind of levels of inducement, we could say that these lows on a lower time frame are probably going to induce a little bit of entry, or a little bit to cause people to want to trade higher from there. We tap in and we start to continue moving to the upside. But one thing that we want to look at when we're looking at flips is we got to ask ourselves which piece of structure, took liquidity, and then that will kind of help us or guide us in which area that we'd want to look at to trade from a demand perspective. In this case, the extreme or the decisional. What is the extreme? The extreme would be, in this case, the lowest point, the extreme of the price leg, and then the decisional in this case would be the flip zone. And what we can see is that price reacts off of the flip zone. But wait, Brad, you said you want to look for something that actually takes liquidity. This doesn't really take liquidity. Sure, there's a little bit of liquidity here, but you said that you want it to take liquidity, prior to the zone forming. That we know from our, point of interest increasers, or whatever you want to call it in the refined series. We look for breaks of structure, we look for, mitigation, or we look for liquidity sweeps. In this case, did we get a break structure? Yeah, it's a change of character, so it's a little bit of a read between the lines situation. Did we get a mitigation prior to that created that zone? No. Did we take liquidity at this area? No, not really. I would, if I just make this a little bit bigger, does any of this look like it took liquidity? In theory, yes, on a lower time frame, these lows would be viewed as liquidity. But if we just look at the zone in itself, did this take out liquidity? No. Did this take out liquidity? No. Okay. But why are we getting a reaction then? Well, if we just go back to why are reactions being created in the first place, chances are this is going to get used as liquidity. So that's what we're always asking ourselves, is what created liquidity, or what took liquidity rather, and that will help us or guide us in whether we can trade the decisional or the extreme. There's nothing wrong with trading the decisional in this case, especially if you're trading intraday. Even if you just target the high as 9 pips, and say you're able to get a 1 or 2 pip stop loss, you're still looking at a 1 to 9, or a 1 to 4, 1 to 5, depending on where you actually get involved. So still great trades from an intraday perspective, but something to keep in mind. So I'll just keep playing price forward. I might end up taking off bar replay, just because, 1, to speed up the video, but 2, because it's just easier. So what we can see is we sweep this zone. So we've taken the liquidity there. Our initial idea would be that price will react off of the extreme. So I'll just speed up price. Obviously, we've seen price react, or we've seen price prior to this, but what we can see is price doesn't respect that, or more specifically, we don't tap into the demand zone. So again, it always goes back to that question of, why did price do that? What's going on? And, there's a little bit of a concept that I'll do a video on in Refine, but basically if we look at these gaps between the candle from this low to this high, we can see that there's nothing on either side of them. This is what we would call imbalance or inefficiency in the markets. Basically, what it indicates is that price was moving so fast to the downside that it was not able to offer bids and asks or buying and selling. It was just mostly purely selling. So in most cases, price is going to revisit these areas of imbalance or inefficiency to rebalance price. And what we can see is that's why price is tapping into these. Now, before I continue with this, I just want to stress that I do not recommend trading imbalance directly. Don't wait for price to tap into an area of imbalance and then just start smashing entries, because you're going to get smashed. Trust me, I've done it in the past. It works sometimes, but more often than not, it doesn't work. So, just get that out of your head. It's more of a tool just to gauge where price is likely to see some interaction and give us an insight of what's going to happen. So more specifically, why did I call it this bit of imbalance? Why did I even mention imbalance? Why are we talking about this? So there's an idea of, if we have imbalance to the downside and then imbalance to the upside, this area right here specifically would be a window of imbalance. And basically what that would indicate for us is that, in some ways, price doesn't necessarily need to trade lower than that. It almost acts as a supply and demand zone in itself. Again, don't trade it. I just need to stress that enough. We don't recommend trading that, but it's an idea that, if we start to see a reaction to this window of imbalance, chances are this extreme ain't getting touched. It's just not. So what does that mean? Oh, we missed a trade, force entries? No, not at all. So what we can do is start looking at structure, start looking at new supply and demand zones, start looking at timings, because I mentioned timing earlier. So what we can do is we'll just kind of move this back. Maybe I can change this to something like that, just to kind of, we'll even just put it in text, just because we can. Window of imbalance. Don't trade this. Just going to put that. I'm going to remind people, because it's so easy to get caught in the allure of imbalance and inefficiency and try to trade it because you want to seem special. You're going to have a bad time. So just use it as a tool. That's what I want to stress. And okay, I'm done talking about that now. So what we're going to see now is, we swept this liquidity. We moved to the downside. In some ways we could say that we have created a bearish move. Obviously, from a structural perspective, even if we're just looking at this, we're probably going to use this as a piece of structure. So we're trading within this range. Why? Because, we broke this structure, something like this. We just barely close above it. I think, if my line was somewhat straight, we just barely close above it. And then we start to react immediately. Again, if we see that phenomena, chances are this is just going to be viewed as an entire impulse. If we see the reaction, this is what breaks structure. We create this low, we create this low. Why are we creating these lows? We're probably going to take them as liquidity. And we do that. And then what do we see? If I just clear up some of this stuff again, we react to the supply to demand flip, but we sweep the liquidity. We move to the upside. We don't actually break anything. We can look at this doji. That's a supply zone. So we're starting to see a little bit of supply taking over temporarily. But again, we always have to ask ourselves, what is our bigger idea here? What are we actually trying to accomplish? Or what are we showcasing here? We're seeing this price action inside of a higher time frame demand zone. So we should be thinking buys initially, but we do want to see clues for potential sells if this demand zone is not going to hold. But right now, we've seen a change of character. We're just kind of plotting out again. If we just kind of do this, we have a couple bits of information. So we know that the chances of this supply to demand flip zone holding are fairly low because the zone itself did not take any liquidity prior to forming. This area did take liquidity because that's in essence what a change of character is. It's a liquidity grab and then a change of trends on a either quicker or more fractal approach. So then when we're looking at this, we're looking to trade the extreme demand zone, but then we've noticed that we have this window of imbalance. So what we can, keep in the back of our mind is, yes, I'm still going to look to trade the extreme, but I know that because this exists, chances are, price might not trade lower. We might just react off of this and continue, but that's okay because we're not going to try and force a trade at that area. Obviously we can see the chart. Obviously this, ends up being, you know, a misconception of trading where hindsight is this bad thing. When you're reviewing trades, and what I talked about, the reason of this video is I didn't trade yesterday, but I want to review the session. I want to see what's happened. I want to understand the order flow. So when we see that, we can see that we break structure, you know, because we broke this low. Where's the highest high after this low? After this low's broken here, it would be this point. So if I just draw, let's draw a line right there. I'm going to get rid of this line because it's bugging me. Okay. So what we can see is, you know, we have another change of character, if you will, within this, because obviously we've broken to the upsides. If we're looking at from a change of character perspective, you know, broke to the upside, then we kind of just hung around here. Oh, this high does break. So in theory, we have a change of character here, switching back to bearish. And then, you know, we see price come back up. We break this low. So this is a change of character from, you know, this whole bearish price leg to bullish. But of course, I got to go back because I don't want to confuse people or say something that doesn't make sense. But we're still trading under this from a kind of more specific level. That's the range that we're trading within. We're just looking at this bit of changes of character and this bit of changes of character to understand the order flow. That's why there's a little bit of difference. Changes of character can be powerful when you kind of understand them a little bit more. They're a tool to be able to gauge certain bits of order flow and just understand things from a fractal perspective. Because again, like I said at the very beginning of this price leg, is if we're looking at structure, we're probably caught more in a price leg, something like this on the 15-minute. But now we're just breaking this bit of price action into kind of more digestible pieces so that we can make sense of what's happening. So with all that said, you know, we've now created another change of character bullish. We don't need that necessarily, but it just gives us a better framework to understand, okay, we've created this high, so we have an impulsive range this way. We've broken structure. We tapped into this window of imbalance. So, you know, what that tells us is there's a chance that we don't have to come down to the extreme. And what we can then do is we can draw another demand zone right here. Why? Because we broke structure to the upside. We have a nice momentous move. You know, we have areas of imbalance. So we know price is probably going to visit those price levels anyway. You know, it makes the area pretty strong, in my opinion. But more specifically, you know, we break structure. It's a good demand zone. Now we can pair that with timing, because timing is important. Where was the previous entries? They were at London time. You know, when we were talking about this price action up here, you know, a trade happened at 3 a.m. Eastern, which is 8 a.m. GMT, which is the London session open. And sure enough, what time does this price tap into this demand zone? It's about 3:45, so it's a little bit later, but it's still within kind of the London kill zone, you know, which is usually anywhere from 2 a.m. to 4 a.m., 5 a.m., kind of in around there. It's basically, if you're looking at a session, we want to identify when the most volume is going to be in the market, when people are going to be, in essence, gung-ho to take trades, whether it be institutions, whether it be banks, hedge funds, retail traders, you know, when is there going to be a lot of volume and orders in the markets? Probably within that window, because a lot of people get really excited, and that's just really when volume kicks in the markets. The beginning of London session, the beginning of New York session, and the beginning of the Asia session are tend to be when you see the biggest pushes. Obviously, if you're looking at Asia compared to New York and London, the Asia moves are usually smaller because there's a lot less volume, but generally session opens, you're going to see a lot of volatility. And chances are that's when you're going to see trades complete. And what we can see is, you know, this is an opportunity to get involved. If you trade strictly 15-minute, there's a valid entry. This is great. Monday, you're already in a trade if you're trading London Open. But let's say you're like me and during London Open, you're snoozing because, you know, it's 3 in the morning. So what we would do is just kind of continue following price. You know, we've broken structure to the upside, so we'd be looking at this wick as a demand zone. You know, that would be part of our demand chain. We start to see price break to the upside again. You know, again, it's not a clean break of structure, so we'd be looking at this whole bit of structure. Now we just kind of zoom back out a little bit and start to ask ourselves, you know, why is price doing what it's doing? Well, we can see we have this large doji right here. Make sure that's locked on, and we'll turn it red. We have a supply zone, you know, and if we look at this from a couple different avenues, we have inducement, and we have inducement. Basically what this is showcasing is we have a supply zone, we're reacting off of demand zone. This is kind of a key level in some cases to break, to showcase a true change in sentiment as a reaction to the higher time frame demand zone. So what we can see is, we tap into the supply zone, we get a reaction, the initial reaction, and then we sweep it. So we swept liquidity. That's a good thing. If we just look at this in a more broad stroke sense, we have a range. What is a range? It's a demand zone forming, but we don't know that until we take out the reaction, which is this right here. And what does that give us? This gives us a supply to demand flip. So if I'll just draw this conceptually. We'll just ignore kind of all this price action. We've come up, we've given a reaction. So this is our supply zone. We've broken to the upside right here, and we've come back down and we've moved to the upside. It's a little bit messy, but this is what a supply to demand zone flip is. Again, I'm going to make content for this. I'm kind of working in a strange order. I know I just want to get back into making videos, and here we are. So I hope this is helpful on all fronts. So we can look at a couple different spots. We have this candle right here, this bearish candle that we could look at as a demand zone, and we'll make that dark so we can see it a little bit better. And we'll just move this back so we can kind of see, if we're looking at supply demand zone flips in a couple different ways, we can see that price comes down, we get that initial reaction. That's a demand zone. We move to the upside, we take out the reaction, we mitigate. So that could be a very aggressive supply to demand zone flip entry. If you want something a little bit more confirmation, a little bit more cleaner, that actually has some structure behind it, then we start to see, we have liquidity, we get that reaction that takes it out. So now we have this larger bit of structure, and then we actually break to the upside. We can probably refine it to something like this. As we can see, it trades a little bit lower, but how much does it actually trade below it? 1.5 pips, depending on where your stop loss placement is. You might get stopped out, but that's just the way she goes sometimes. But if we just look at this, I would be interested in kind of this wick range. If we're drawing it, we could do something like that. We have a larger range. So there's a little bit of interpretation, what we could probably do, as well as maybe go up to the 30-minute chart. Does anything stand out? Probably not. Maybe we go down to the 5 minutes just to kind of refine this range a little bit. Again, this wick is speaking to me in many cases. Obviously, we get a little bit of price action within it. We can probably, cut it out. We could probably even, go to this wick. That's being super, super precise in some cases. We'll just move this back. It's this. It makes sense. So, this is where a little bit of interpretation is going to be led. And I want to preface that because, there's going to be trades that happen that you might not be able to get into because you drew the wrong zone, or maybe you got stopped out. That's okay. It's just about understanding why something is valid or not. And, what makes this valid in a couple different scenarios or different ways is, this flip zone takes out liquidity. We break structure right here. So I'm just going to be drawing tons of lines because, as we know, I can't draw straight and want to just make sure that this makes sense. We have this flip zone as well. And we also have a little bit of a demand chain starting. So we have, a mitigation that creates a zone. This is the reaction. We're drawing it off of this. We break structure, and the flip zone itself takes out liquidity, as well as it's just a flip zone. So a lot of confluences to look for potential trades. So we'll just throw on a entry here just to show this one. This would be the London Open trade. And this is your New York trade. This is about 10 a.m. You'll get entries anywhere from 10 a.m. basically to 8 a.m. to 10 a.m., 10:30 kind of is the window for New York, sometimes up to 11 because that's when New York closes, London closes, and there can be some volume changing hands there. So basically, if we look at this, we have a 3 pip stop loss on this trade. This is just using the proximal as the entry. You can get a little bit more precise if you'd like to. I have mentioned in previous videos that I like to enter on the 25%. I don't know what's going on with my fib, but I don't. Actually, I'll do 75 because I drew my fib backwards. Or did I? Yeah, there we go. So we have the 25%. fib. In this case, it's 75% just because I drew the fib the wrong way. But, we could then use more of a 2 pip stop loss if we wanted to. We could emulate the same thing here and then just draw that out, draw it to the 0.25 or 0.75. Then you could get a pip. I like to be a bit more pip and a half, but that's just me personally. I don't feel like stretching my trades too much. I want to be mindful of what's happening to the left. But, solid abilities, you could enter on equilibrium. In this case, this trade would not trigger. This one would. So that's just kind of the risk you take with certain entries. I like to stick around the 25%, or in this case, 75% fib, because I drew it upside down. So then it goes, okay, we're in these trades, great. This is 15 minute. I'm not even gonna go on the 1 minute. You can find entries on the 1 minute, but the 15 minutes powerful. So what we can see is, where's the first logical target? Probably this larger 4-hour pivot supply range, makes sense. We can also look at something like this. Not the greatest example or zone. It's not really high quality. It doesn't really do anything. Actually, let's back it up because it does do something. And this is why you ask why. Why did this happen? Why did that happen? If we draw this is a demand zone. So if you're looking to buy, this would have been an area to buy from. Because initially, if we didn't have a tap into this zone, I'm pointing at it, but obviously I have my mouse here. We tapped into this and we started to move to the downside. You might have looked to buy here. If this would have been the demand zone that you'd look to buy, we'll change it to an actual demand color so it makes sense. So what do we get here? We get a reaction and then we break to the downside. So in essence, this is a demand to supply flip. It's, in my opinion, a lower quality one. So then we ask ourselves, why did that happen then? Why did we switch from demand to supply? And should I be either closing my trade at that point, or should I just manage, or, what should I do? The best thing to do in this situation is just use this as either an initial target. Maybe you have a target 1, because if we just draw something like this, 17R on a 1.5 pip stop loss, if you do something like 3 pips, it's still 8R. And this is something I want to showcase because some people are, swinging for the fences, trying to get 30R trade. 10-hour trade is great, especially if you're risking 1% or even 0.5%. A 10-hour trade is 10% on 1% or 5% on 0.5%. So, you're still doing incredibly well. Obviously then you're going, but Brad, if I risk 1% and I make 30R, that's 30%. It's like, yeah, that's great, but I digress. Anyway, so what we can gain from this is that we're probably going to get a reaction to this zone, but it's probably not going to follow through. Why? Because we've tapped into a higher time frame demand zone. That's why, because we need to ask ourselves, what's actually built up to here? What are these areas, or what are they showcasing? What are they telling us? At this point, we're mapping out supply zones. One, to look for potential reversal trades, because we do know that the sentiment on the 4-hour is bearish. The daily is bullish for the most part. We can argue that it's still bearish, that this is still the impulsive range, and this is just kind of substructure within it, because again, like I mentioned, if we see breaks with no continuation, chances are structure is going to get targeted, and then you would use all of this as structure. So we can come back to here for shorts, we can come back to here for shorts, or we can come back to the extreme for shorts. They're all open for business, so to speak. So that's the rationale on why you could pivot from demand or supply, looking to buy or sell. The buy might be counter trend and the sell might be pro trend, or, we might actually be switching to bullish market structure. Therefore, the buys are pro trend and any sells that you would take would be counter trend. But this is why, I went on a spiel about making sure that, yes, we should be forecasting, but we shouldn't just be held onto our forecast that that's what has to happen. We need to be a little bit more reactionary, and this is how we're able to do that. But yeah, we have this 4-hour level. This is a good spot to look for potential profit taking, maybe even look to take a hedge for a sell, or even close the buys and look for a sell if you have some conviction that this is the zone. And what we can see is we haven't actually hit that yet. What we've done, if we just kind of look at things a little bit further, we have a reaction, and we take out that reaction. So if we look at a couple different zones, obviously we can see what ended up hitting was this zone right here. That's what we've reacted off of now. It's not looking, great, because if we just look at something like down here, just use this range. We can use the wicks, but we can use the whole candle, or refine to even something like this. What we can see is price doesn't respect it. Kind of blows through that level. If we just dissect price action, again, this is just what we do. We just dissect price action. We ask, why did this happen? Why did this happen? And we just continue that process. So we have a change of character. There's our low. So we actually have a true change of character that takes place here. Should we be looking for sells here? I would be in the mindset of no. And the main reason why, and you've probably heard me say this many times throughout Discord, is a change of character in the middle of nowhere is useless. So if I just scrunch chart a little bit, is this happening anywhere specific? Not really. You could argue, again, on a 15-minute, you have these wicks right here, which is a pivot supply zone. You toss this over, you can say, oh, well, we reacted off of it. I then ask you the question, we broke it. Did we really respect it? No, not really. If we go from a concept of imbalance, we have imbalance here, we have imbalance here, we have imbalance here. Chances are price wants to fill that. Does it have to happen immediately? No, it doesn't. So when we're looking at that, yeah, you could argue that there is a reaction and that change of character is warranted. I'm not as big on pivot wicks like this. I'm aware of them, but I don't directly trade them if I don't have to. I would look for a continuation. So maybe I would have my eye on this as a level because, we've reacted off of a supply zone. It's not great in terms of how it's formed or anything like that. If we go through our checklist of different things of what makes a supply zone valid or what makes it high probability, that's not high probability to me. But, we look at this, we see some sort of reaction, we see that change of character. We'd be looking at a supply zone. We have some inducements above it. We get an initial reaction. It fails, as we can see. Where did it target to? This demand zone. Do we have any indication that we could have traded that demand zone? Well, probably not. That's kind of just pulling a zone out of thin air. But what we can see is that's what price pulled to. We took out these equal highs. We have a liquidity sweep. Now we have another change of character. Again, we're not really in a zone, so can we classify this as a true change of character? In many cases, no. Can we trade it? I wouldn't suggest it, but what we can see is, we just barely tap in. Actually, I don't even know if we tap into that. Yep, we just barely tap into that, so maybe you could have traded that short, but what we can see is, the first level of demand has failed. Right here, we tap into this area. If we just look, we just break below it. So we've kind of like taken below here. We have this demand zone, which, we have some nice inducement that's kind of being built all below it, or above it, sorry. And then what we can see now is we have tapped into that and we're starting to run off. If we go down to the 1 minute, has there been much that's happened here? Let's just zoom this in. Not really. We don't really have a change of character. No, those are equal lows. If we're just kind of looking and maybe reading between the lines a little bit, we have this high. We break that high. We're starting to showcase a demand chain, maybe starting, on a lower time frame. Maybe we could say that that's a thing, but now we're just kind of pulling random things out from behind us. Once we see a break of structure here, then that's more of a 1 minute change of character that I personally would be looking at, because we'd be trading between this range. Now we've actually broken. There's nothing that indicates a low, or if we look at this is pretty much equal, I believe. Let's just look. The low is 826 and this is 826, so these are equal lows. So I wouldn't classify that as a change of character. Maybe you do, maybe you don't. That's up to you and your plan and your testing. But this is why you can take a 15-minute entry and it would work. You have enough reason to look to take that trade. Maybe we do something like that. We'll just toss the fib over. This will be a little bit bigger of a zone, which is fine. Toss that on the 0.25 fib. It's a 4 pip stop loss. Maybe this is where you stretch for the equilibrium. Chances are this trade, based on what's happening, is not looking like it wants to hold. Just looking at price action, we're now kind of just having demand zones failing. print that back on just for now. So we'll just delete that for now. But basically we're just, again, the whole purpose of this video is just kind of asking ourselves why, digging into price action. This is what I do on a daily basis or every other day, especially the days that I don't trade or I'm not able to trade. If I'm away from the charts, I just dig into the charts and begin to ask myself, why did this happen? Why did that happen? Why did price react off of this? Why did price do that? Why did price do this? And it gives me a stronger level of understanding of the order flow. You can see I really only went down to the 15-minute chart. That was all that's really necessary in some ways. If then you want to take it a step further, you can just kind of go back and go, okay, would I have been able to get involved in this trade on the 1 minute? No, you probably would not have been able to, and that's fine. Unless you're taking some sort of a risk entry on some zone that maybe you draw from here, then yeah, maybe you can get in. This is where the 15-minute does become powerful. I know a lot of people are interested in more 15-minute geared content as well, so I hope that this kind of helps showcase that a little bit better. So yeah, we go here. Now we have, this zone that we'd be waiting for. Let's just kind of move price a little bit more. So we break structure. Now we're interested in that zone. Let's go down to the 1 minute and see if we get any sorts of change of character to do a 1 minute entry. So what we can see is, did we break that low? 89, 70. So these are the exact same. What we could say is, if we just look at this, we have a low here. We break below that, where's the previous high from there? Maybe we look at something like that as our change of character. Break to the downside. I have no idea what just happened there. That was weird. So we broke in, maybe we can be interested in a zone such as this. Demand, toss that on. Do we tap into it or does price run away? Price runs away. So this is where we then take a little bit of studying of the actual order flow. I'm not going to go on the 1 minute, just this video has already gone long enough, but then we would basically take the exact same process that I've done with the 15 and the 4 hour and start looking at it in a 1 minute perspective. And then we can plan entries from there. Because, if we look at something like this, we have a zone here, we get a little bit of a tap. So we're starting to see a demand chain. Price taps in here. Maybe you just had your zone drawn on here, different things. Again, I'm not going to go into it. This video would be all day long and I don't want to waste too much of your time already. But yeah, I hope that this was helpful. This is kind of the review process that I go through with some really poor bar replaying, maybe some poor 1 minute price action study. But the more focused point or message I was trying to convey here is just the importance of reviewing the session, especially on days that you don't trade, that way you're just kind of aware of how order flow and price action has presented itself in that session. You're applying the edge every day so that you can better understand and practice, what we're learning so that you can actually apply it. It's going to build confidence. If you're seeing the same things every single day, that's the biggest thing, I think, is if you see this phenomena, this price action, this stuff happening every day, you're going to be more confident to execute. But it's going to take time. It's going to take effort because you're going to actually have to go through this every day. And, it's important, again, just summarizing, to continuously ask the question, why is this happening? Why did that happen? Why did price react here? Why did price print this structure? Why did this happen? And then dig into it and start to dissect things. We focus mostly on 15 minutes, so I hope that was helpful. But the process would be the same for your 1 minute entries. You would just then go, okay, now that I have these 15-minute zones, plotted out, I understand why they worked. I understand why they came to be. How can we then take it to the 1 minute chart to look for entries? So maybe enter on the 5 minute or whatever the time frame it is that you enter on. If it's a 15 minute, great. We're already done. If you do the 1 minute, then you got a little bit more work to do, but it's the same process. And when it comes to trading, this is the meat and potatoes of understanding the edge. This is the fun of it. And, if you don't enjoy doing this stuff, trading is going to be incredibly difficult to continue on with. I'm not saying that it'll be impossible, but if you don't enjoy asking the question why, if you don't enjoy studying why price action is doing what it's doing, chances are it's going to be kind of an uphill battle, so to speak, in your progression because you're fighting something I love doing stuff like this. I love being on the charts. I love dissecting things. My natural curiosity of why price reacted off of certain things is what keeps me coming back every day. The fact that I can earn a very nice living from trading as well, definitely makes it a lot more fun and rewarding. But through and through, I'm big on video games. I've always loved playing video games. This is like the most challenging, but probably the most fun video game that we can play. So that's kind of how my mind perceives trading and studying charts. So fall in love with the process from start to finish, and everything will just fall into place that much better. They say if you love what you do, you'll never work a day in your life. And, with trading, that's a very true statement. I think I speak for myself and the team as a whole that we all love this stuff. We love it more than probably many things, especially if you compare it to a conventional 9-to-5 job. You dread to go to work, but when it comes to trading, jumping out of bed in the morning, to go and trade and to look at charts and talk charts with people, to me, there's nothing better. But before I waffle on too much, that was kind of the video that I wanted to put out. I won't lie, I kind of just jumped into both of these videos today blind, but I wanted to put something out. I want to start, getting back into doing more videos again. So I hope you found this helpful. If you have any questions, feel free to reach out or tag me or the team in the questions channel. Cheers.